There are two different inventory systems. One is perpetual inventory system. The other is periodic inventory system. First, what is a perpetual inventory system? Basically, we are going to adjust the inventory accounts continually. When the company purchases inventory, the company is going to debit inventory accounts to record increase in the inventory. If there's sales, company will credit the inventory accounts. Sales return, there will be a debit inventory accounts. The accounts of inventory is continuously adjusted according to the transaction. At the same time, the company will record the cost of goods sold when there is a sales or when there is a return by the customer. I will show you an example later. So since the company continuously adjusts the inventory accounts, so the managers can determine the goods anytime and also the number of inventory sold during a period. This company purchases soft drinks from producer and then sell them to the retailers. The beginning balance of inventory was 120,000. And during this year, the company purchased $600,000 inventory on account. The sales on account was $820,000. The cost of the drinks sold was $540,000. The ending balance was $180,000. Let me show you what's the accounting of perpetual inventory system for these transactions. First is the purchase on account. The company debit inventory, credit accounts payable, because it was a purchase on account. There's a sales, 820, so it will recognize accounts receivable and the sales revenue because it was sales on account. The cost of the inventory sold is $540,000. So we debit cost of goods sold and credit inventory. Two transactions that have impact on inventory. One is purchase, so we debit inventory. The other is sales, we credit inventory. So whenever there is a purchase, we debit inventory accounts. Whenever there is sales, we credit inventory accounts. The perpetual inventory system are commonly applied because it helps companies to maintain a record of inventory transaction. But maintaining records under perpetual inventory system is very time consuming because the company need to physically count the value and the volume of inventory purchased and sold. Thanks to the technological advancements, companies now can maintain the perpetual inventory system with very low cost. Whenever we visit Walmart, we just scan the barcode of products. From the Walmart side, that is sales. When we return the goods, we also scan the barcode, or the cashier will scan the barcode. The system will record a return. Similarly, if Walmart purchases from the supplier, it also scans the barcode, which includes the information about the inventory, the price, the dates, and the volume. Perpetual inventory system in practice is very commonly used. Differently, what is a periodic inventory system? Since it is periodic, means we only adjust inventory accounts once every accounting period. When? At the end of each accounting period. So the purchase, the sales, the return, and any accounts related to inventory we just set up the temporary accounts. And finally, we can determine the ending balance of inventory or cost of sales based on this equation. The beginning balance inventory is available. We use purchase account to track purchase. Actually, we don't need to track the sales. At the end of accounting cycle, we just check the balance of inventory. According to this equation, we can have the cost of sales. Different from perpetual inventory system, the balance of inventory accounts keep adjusted according to the transaction. Finally, we can have a ending balance of inventory automatically. The periodic inventory system does not track these transactions. It only changes the inventory accounts every period. A similar example, let's just use periodic inventory system to record all these transactions to see how we account for the change in inventory accounts based on periodic inventory system. Beginning balance was still 120,000. There's one purchase, one sales. See, we don't have information about the cost of the sales because the cost of sales is determined by this equation at the end of this accounting cycle. Same to the perpetual inventory system is by the end of accounting cycle, we have the balance of inventory from physical count. This is beginning balance. This is purchase. This is ending balance inventory. And we have cost of sales based on this equation. How we record this transaction differently, we do not debit inventory, instead we debit purchase. Sales is same thing because revenue accounts receivable has nothing to do with inventory and cost of sales. By the end of accounting cycle, we make a single journal entry. We debit cost of sales, debit ending balance of inventory, credit beginning balance of inventory, credit purchase. Beginning balance 120 is given. Purchase 600 was also given. Ending balance of inventory is also available. We just need to calculate the difference using the sum of beginning balance of inventory and purchase, subtract ending balance of inventory. The difference is cost of sales. Actually, this journal entry shows us a equation. The equation is the sum of cost of goods sold plus the ending balance of inventory equals the beginning balance of inventory plus purchase. While these two accounts are debit, while these two accounts are credit. We just put the right amount. The only number to be calculated is cost of goods sold based on this equation, or just based on this equation. So here it shows us the procedures. Beginning balance was available, purchase, ending balance of inventory. So cost of sales, 540. We can make this journal entry. Cost of goods sold is determined by this equation, not from tracking each sales. That's the difference between periodic and perpetual inventory system. Let's take a look at the perpetual inventory system. We debit cost of goods sold and credit inventory when there was a sales. Under periodic inventory system, we do not have such journal entry. Why? Because we don't track it under periodic inventory system. Since The periodic inventory system does not track the purchase, return, sales, so on and so forth. It is less costly and easier. Okay, so usually it can be used by a small business because it is very simple accounting. So here is a summary, the difference between two inventory systems. This example is an application of the equation I showed you. The information includes sales, beginning balance of inventory, purchase return, and the ending balance of inventory. We are asked to calculate cost of goods sold. Then we just base on this equation. Okay, the beginning balance of inventory is given, purchase and ending balance of inventory are all given. The only difference here is the purchase return. So basically we need these two, the difference of these two, to get the net purchase. So the net purchase is 594,000. Then we use the beginning balance of inventory plus the net purchase. That's goods available for sale. And subtract ending balance of inventory, which was given. We can have a cost of sales. Another one is we are given the cost of sales. We are asked to calculate ending balance of inventory. Similarly, we also use this equation. Now, this is unknown. This is a given. Right? This is like solve a equation. Very simple. We just use beginning balance of inventory plus the net purchase. We just subtract the cost of sales. We can have an ending balance of inventory. So the answer is $370,000.